Hey guys, Ben from Pivot, and today I'm bringing you the money news in human words, helping you understand the key things that you need to know to see through the headlines and figure out what it all actually means for you. Now, the first piece that I've got for this week is off the back of um, the interest rates increasing through the RBA by 50 basis points to the back end of the front end of last week, rather. That saw the average interest rate increase to or the cash rate rather to 1.35%. But probably more concerning is the fact that we've now seen priced into the cash rate that rates are tipped to increase to 2.5% by the end of this year and 3.5% by the middle of next year, which, given that our current interest rate is 1.35%, it's a really significant jump. And means a lot of extra dollars for mortgage holders when it comes to their mortgage repayment. So, look, I think that reading through these headlines, that obviously the driver of this is the inflation rate, which is running at a massive record high at the moment of 5.1%. A lot of that, and to get it without getting too technical around how the inflation works and what the RBA do to set their rates, is around the fact that the expectations of inflation, that when people expect inflation to increase, they're more accepting of higher prices, and then prices tend to increase further. So I think it's probably actually a bit of a good thing in the fact that the RBA has come out taking such an aggressive stance to interest rates, because what that does is it tends to temper the expectations of people, that they feel that inflation is going to be brought back under control more quickly, and therefore that tends to have a downward impact on inflation. But borrowers obviously need to pay more, and I think the impact here is that a lot of people are talking about that. Hold on a sec. A lot of people are talking about the fact that like it changes the strategy around your mortgage borrowing. So the fact that the rates are higher means that your tax strategy becomes more important. It means that looking at interest investment loans versus non-investment loans is really critical. It means that strategic consideration decision set, it actually changes. So I think for any mortgage holders that are out there, and particularly people that have multiple mortgages, that you want to be really on the front foot with your strategy, so that you can you make sure that you're making the most about it. Looking at things like debt recycling, or which mortgages you pay down, offset versus redraw, as well as make sure that you've got good risk management in place, more important than ever in the face of rising interest rates. The next thing I wanted to cover is sort of in the same vein, where we're seeing a lot of talk about this property market squeeze, and look, there's a lot of data talking about, we've seen the actual value of properties go down. Sydney, Melbourne, sort of leading the charge there. We're still seeing some upticks in some of the other states, Darwin, Adelaide, and Hobart. But certainly the bigger eastern states are going negative, and all of the states are slowing down in terms of their growth. We're also seeing, particularly in Sydney and Melbourne, a lot of unsold properties, auction clearance rates down below 50%. And a really interesting number is that the listings are way down in Victoria. In Sydney, they're down 1.5% from the same time last year, but down a massive 17.6% in Melbourne, which is the number of new properties coming onto the market. So that's really huge. And yeah, it does show that people are worried about the property market continuing to go down. Now, I was looking at some of the data around this over the weekend, and we see that there's a not perfect, but an almost perfect correlation between consumer sentiment and what happens to property values. So what that means is that how people are feeling about what's going to happen in the property market dictates what actually happens in the property market, which sounds like it should be something that's maybe a little bit more based on economics and fundamentals. But as we know with investments, that human beings are the main drivers of investment markets. So Look, I suppose what that means is that fear from investors in particular can and will be the driver of the market, either one way or the other. That if people can see through some of this noise, then it's going to mean that prices are impacted less. Whereas when people get super fearful, means that prices are impacting more. Another interesting stat that I was looking at around the property market is I found that market downturns in the property market tend to last around half the amount of the property market runs. So what we saw in 2000 to 2004, there was a property bull market of 42 months. The downturn lasted 18 months. And interestingly, another stat is that the run up in the property market, so the run up to the peak prior to a trough, has in every single case been more than the dip from the peak to the trough when there is a property market downturn. So I think that should give investors a lot of confidence that even if a lot of this fear sets in and the property market does suffer, it's likely going to be not as much as the gains that have been made. And it means that when things do recover, that they're set to rebound further and faster than we see in the downturn. So Sydney, Melbourne, we know that those markets are more volatile. They have more ups and downs, more impacted by the gains are more in the market up cycle, but the losses are more in the market down cycle off the back of higher debt levels and higher income levels in those states. Uh, we're likely to see some wobbles there. Look, there's a lot of doom talk out there. We never like. I don't have a crystal ball, but in my take, I don't think that it's going to pan out the way that a lot of the doomsayers are saying. And I think that there's a ton of opportunity there for property buyers that have the right strategy and, importantly, have their risk protected in the current environment. Next one is a little bit related to this, which is about the bank's glory days being grinding to an abrupt halt, with their dividends being forecast to remain below pre-COVID levels and their share prices all copping a big hit over the last little bit. They also talked about the fact that share buybacks are set to stop for the foreseeable future. And this is a share buyback is where a company is, and the banks in this particular case is buying back their shares. And what that means is that there are fewer shares, so every share is worth more. And it also means that there are fewer shares to distribute their profits to through dividends. So it means that the dividends end up being higher. Now, the markets clearly don't like that, because off the back of this, we've seen the share prices sort of is a little bit in conflict with the fact that when interest rates are increasing, banks tend to do better because their margins increase when the interest rates are higher. But some of the factors that are driving the slowdown in banks' performance is around the fact that the banks they generally tend to do worse when the economies are not doing well, and that's because people are borrowing less, they're spending less on credit. The growth in new mortgages is slowing right down because there's less people in the property market. And it also is partly that banks then need to keep more money aside for their risk management strategies, so that they're protected if there are defaults in the property market or anything like that. Look, I think in my take, there's potentially some good buying in the bank sector as markets go down, or through an index investment, which has a heavy exposure to banks as being the biggest companies in Australia, to take advantage of the recovery that is coming, so that your share portfolio ends up being worth more on the other side of this period of disruption. Next piece I was looking at over the last week that caught my eye was around Zip Pay shutting down its a personal finance app, Pocketbook. Basically, if you didn't know, which I wasn't fully aware at this time, but Zip acquired a spending tracking and budgeting app called Pocketbook in 2016 for $7.5 million. Basically, a free app that helps you manage your finances better and gives you reporting and tracking dashboards. This particular app had 800,000 registered users, which is a pretty significant amount, and by all sort of measures was performing quite well. But off the back of some serious increases in bad debtors and rising interest rates and some pretty substantial losses for ZipPay, um, they've decided to pull their focus, to basically shut down Pocketbook so that they could pull their focus back onto their core business. So I thought, wow, that's a pretty interesting move, especially after shelling out so much cash for this app that was all seemed to be performing quite well. But when I started looking in the numbers, there was some pretty scary stuff in there. That the value of ZipPay as a company had increased from $6 billion to around $600 million, a drop of 87%. Um, then we're seeing more regulation coming into the buy now, pay later space. Zip's performance, they just had a record year from revenue growth perspective, but still managed to post a loss of $172 million. And the commentary around the shutdown for Pocketbook was that Zip was trying to get on a path to global profitability. And I think that this shows that when you're investing, for investors, when you're investing in a company and they start diversifying their operations too far, it can drain cash, like is the case with this Pocketbook app, but it also drains their focus, means they can't be as focused on their core business activities and can have a downward impact on the share price. So, bit of a sad day for Pocketbook users, but yeah, interesting from the buy now, pay later space. Their share price is down from $15 to 51 cents from their highs, which is a pretty huge drop as a one-time market darling. Shows the fact that no matter how good a company might seem like it's doing from the outside, when market conditions change, and particularly when there are changes in the space that they're operating in, it can have a really significant impact on the share price performance. So definitely a lesson to be learnt there. My last piece for this week is around the Mt. Gox Bitcoin shutdown and their pledge to repay the $5.5 billion in frozen Bitcoin through their exchange. If you're not familiar with the Mt. Gox story, they were one of the first centralized exchanges in the Bitcoin space. And at one point, they were responsible for 70% of Bitcoin transactions globally, which is obviously pretty huge. Basically, in 2014, through there are a number of issues internally, and they ended up shutting down the platform and basically froze all of the Bitcoin that was held by investors through Mt. Gox. At that time, the Bitcoin price was 320 US dollars, and it's now $20,000. So for anyone that had Bitcoin in there in 2014, they're sitting on a 63 times profit. Pretty amazing. Although there was some commentary from investors in this piece I was reading about the fact that they were disappointed that they weren't able to trade their Bitcoin throughout the course of the market cycles that we've seen over the last 8 years, and felt like they would have made more money as a result. For me, from having talked to a lot of people that have been trading in Bitcoin heavily, I'd say that it's much more common that people lose more than they win. So being forced to hold for the long term was probably a good thing for a lot of people. Interestingly, though, with this one, that the money is due to be paid back between now and sort of the end of August, and there's 150,000 bitcoins that are going to be released into the market that have been locked up for quite some time. They're talking about that having a further downward impact on the Bitcoin share price or Bitcoin price or value. So off the back of what we've already seen, a 63% decline over the last sort of 8 months or so, potentially some more pain to come. Interesting to see as that starts filtering through what happens, but good for their investors, obviously, to see their money coming back. Guys, that's all from me for this week. I hope you found that helpful, and I'll catch you next time.